Hello everyone and welcome to This Week in the Markets. This week we'll go through the jobs report that were released last week and also the US presidential election outcome and how that could affect our outlook. We'll also have a brief discussion of our short and long-term outlook of the US equity markets, and we'll do that right after our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the jobs report last week was quite reassuring for the US economy, with the ADP private sector report and the non-farm payrolls both being better than expected. The first estimate of the October non-farm payroll suggests that 171,000 new jobs were created last month. While skeptics would say that this is not enough to even keep in pace with population growth, and yes, we do agree that this is not the 200,000+ jobs that we would like to see, but it is a far cry from the recession calls that some are making, and at least the economic recovery is moving in the right direction. And also we saw from another piece of economic data last week the ISM manufacturing PMI and factory orders. As you can see, the ISM manufacturing PMI in white suggests that the manufacturing sector in US is expanding for a second month after falling to a contraction phase in June. And factory orders in yellow increased by 4.8% last month. This is the fastest pace since March, and both figures were also better than analysts' expectations. So this points to at least to show that US economy is recovering and moving in the right direction. So Obama defeated Mitt Romney yesterday in the race for presidential election and gained another 4 years as president of the United States. This was a temporary relief for the market as it removed one uncertainty that has plagued sentiments in the past few months. However, Congress remains divided, with Democrats having the majority in the Senate and Republicans kept a solid hold of the House of the Representatives. This becomes a problem as it had in the past because the division in Congress means that neither party will have a clear mandate, and that means it remains a clear challenge for Congress to come to a compromise for issues such as the fiscal cliff and how to stimulate the lackluster US economy. For us investors, it means that we're probably not going to see too much aid from the government to stimulate the economy, but still we don't think the US is going to just fall off the fiscal cliff, because neither House of Congress would want to see the $400 billion tax increase and spending cuts come in place at the start of next year, because this could potentially decrease the US national GDP by around 4 to 5 percentage points. So it is a matter of whether something would be done, but rather how much and would it be enough. And that is the compromise that Congress would need to reach. For us, we don't really care too much about how much is achieved, but whether it is below or above the market expectations. Currently, it seems like the market is not expecting a lot to be done, so perhaps it might not be too hard to exceed these expectations. The S&P 500 had a wild ride last night. Futures were falling as polls were being counted, but rallied after it was confirmed that Obama had been re-elected on a sigh of relief. However, the relief rally did not make it until the market opened, as the president of the European Central Bank, Mario Draghi, warned that the 3-year-old crisis in Europe is starting to take a toll on the German's economy. The S&P 500 ended down negative 2.37% to 1394, and this is one of the second largest decline in the year. Looking at the daily chart, we see a bearish short-term pattern developing. The index was initially consolidating after the QE3 announcement, which was expected. It then followed on to break this consolidation and also the 50-day moving average, and remained in tight trading range after that, as US entered into the election period. In the last 5 trading days, there were 2 attempts to test the 50-day moving average, but it fell back down. And yesterday, the equity index made a decisive move to the downside, pulling away from the 50-day moving average and breaking below the support at 1400. As well as been the previous support, the 1400 is also a psychological level, so it is likely that sentiments will deteriorate quite quickly now the index is below that level. However, as we noted before, bearish sentiments as measured by the AAI sentiment survey, as you can see in this chart, is still at quite an elevated level even with last week's slight increase in optimism. Generally, the end of bull market is characterized by investors reluctant to toss in the towel, but what we are seeing here is actually the exact opposite. Investors are actually too eager to switch over and have been going against the trend, even before a major sell has took place. So although short-term bearish momentum, as you can see just then, could bring equity markets lower, but from a contrarian perspective, we don't expect the pullback to result in anything more than just a normal market correction. And so we will keep with a bullish long-term outlook. With that being said, we'll conclude this week's video here. We'll have another update next week after seeing the ECB rate decision meeting tonight and the Eurozone finance ministers meeting on Monday. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.